Today I'd like to take a bit of time to reflect because it really has been a remarkable year since the start of the whole Wu flu situation, and beyond all of the social and even the economic impacts of the government's response to the Wu flu and the flu itself, and all the deaths and everything. There has been and some incredible events in the financial markets, which I think are worth reflecting upon, because we are approaching a point in which I don't see how the continued euphoria of the past year, or more than a year now, because going back to March of, the March lows in 2020, ever since, we hit the lows back in March, it's been to the moon. And not just, certain stocks, not just all stocks, bonds, real estate, everything has gone to the moon since March of 2020. And even people who put, total faith in the ability of the Fed to manipulate markets to their whims, everyone agrees that the pace that we've seen since March of 2020, this rate of growth, which continues to today, can't go on forever. The chart is pretty clownish. I think we've reclaimed the trend line that broke after the dot-com bust. I think it goes back that far. I'm not a chartist, but somebody was throwing that around just as sort of a ridiculous indicator a few days ago that I saw, and I thought, wow. If what is resistance? What is upward resistance at this point? And the answer, of course, is nothing. There's nothing left. I see no more upward resistance. Nobody can find it. We have gone to the moon. We're there. And so now that we're here, where is there left to go? And I'm not saying that means that things go down. I certainly haven't seen that in housing yet. I am remaining skeptical on housing. I guess you could say I'm a hold for now. I don't think that you should just, well, if I owned housing, I would probably be selling right now. If I had excess housing, I'll put it that way. But then again, I had much more reason to believe that housing was at its peak in 2018. And the same thing with the stock and the bond market back then. We had much more reason to believe that in December of 2018, the markets were at their peak, or actually below their peak, because I believe financial markets started to break down in fall of 2018. But it wasn't until really the start of 2019, I think, that the Fed ended up capitulating and reversing course and trying to build things back up. But now we have no sign that the Fed is going to tighten in any serious way. We can't even get solid commitments from the Fed on tapering QE, which, as of 2018, there hadn't been any QE in years. Back in 2018, we were still talking about rate hikes. We're not talking about anything nearly as aggressive as that now. The idea of a rate hike is it's pie in the sky at this point. And so with that said, is it really that simple? Is it just the Fed keeps on printing and prices can go up forever, that the Fed is that powerful? I mean, I've seen the charts that seem pretty convincing. The Fed's balance sheet growth versus the S&P seems like a pretty tight correlation here in recent months. But how much of that is the market following the Fed's lead? Because if that's the case, if in fact it's not actually QE that is directly bidding up the price of financial assets, if, let's say, some of these guys who say that QE is nothing but a placebo, of which there's a strong contingent, I don't necessarily agree, because, of course, empirically, I think that the evidence would suggest that QE does have a very real effect on asset prices, and, of course, I think logically QE has an effect on asset prices, although because I have a limited understanding of the plumbing of the financial system, I cannot defend that position as strongly as some of these people who do claim that QE is nothing but a placebo. But let's take for argument's sake that is true, that QE is a placebo. What is the effect of QE? QE is to change the psychology of financial market participants, and so that when the Fed is pumping money in through QE, people go, oh, this is a good time for me to buy financial assets. So they buy stocks, bonds, and real estate. Well, if that's the case, if in fact these are folks just following the Fed's lead and the Fed is not having a direct impact, these folks will run out of money eventually. We will get to a point to where there simply are no more buyers. And at that point, all the Fed could do is try and convince those folks not to sell. The Fed could not compel people to buy assets that they do not have the money to buy. Once your portfolio is allocated 100% to stonks and 0% to cash, you're all in. There's nothing more that you can do. No matter how many times the Fed comes out and says, we're going to let inflation run hot, you can't go out and buy more stocks. And remember, even though I think that the Fed has a real effect on asset prices, in a real sense, I think that the Fed is a market participant, not just an expectations influencer. When the Fed conducts open market operations, they're only purchasing treasury bonds and mortgage-backed securities. They're not going out and buying stocks. What they're doing is they are forcing people who otherwise would buy mortgage-backed securities and treasury bonds to buy riskier assets and push folks out the risk curve. And that's what pushes people into stocks. So it is still, at the end of the day, it's not the Fed who's going in and making the stock market go up directly. The Fed is not buying stocks. The Fed is forcing people who want to buy other assets into the stock market because the Fed is soaking up lower risk securities. And so again, that to me would suggest that there is a somewhat finite limit on there has to be a ceiling at some point on the stock market, and not so much on the real estate market. The Fed does directly influence the real estate market by purchasing mortgages. The Fed is dumping money into the real estate market. There's no question about that. That's a pretty direct relationship. Maybe once we get to that point, we will see what a lot of folks have predicted for a long time, and that is that the Fed will just outright buy stocks, or buy ETFs. After all, the Japanese central bank, or the Bank of Japan, as they're called, but they are the central bank in Japan. They have been buying ETFs, stock market ETFs, for a very long time. And by the way, the Nikkei still couldn't squeeze out a new all-time high. Their all-time high was set way back in 1991, and they never hit that again until the last couple of years, in the most recent, in the more recent bubble. So eventually that even wouldn't work either. But the Fed hasn't done that yet, so I wouldn't count them out totally until they've tried and they've expended that bit of ammunition. But that's still something that the Fed has in their back pocket. The Fed won't use that, however, until there is a sign that it's necessary, until things stop going up on their own. And so once we hit this limit, wherever it is, I don't know where it is, because again, market cap to GDP is totally unprecedented. I think the highest we got before was like way back in 2000, it was like 114%. And I remember, we blew past that a long time ago. Now we're at 240-something percent, 250%, I think, depending. I don't know what the latest estimates are for Q2. Back in Q1, it was 230-something is what the final number ended up being. And that means that the market cap of the stock market is, about 2.5 times the size of the U.S. economy. A more normal, healthy market cap to GDP would be somewhere in the range of like 50% to 75%. 1/2 to 3/4 the size of the U.S. economy. That would be a more reasonable market cap to GDP. And this is totally ignoring all of the repo problems that the Fed seems to be creating through its current policy, because the Fed buying up a lot of these lower risk assets that have uses, that have utility in financial transactions as collateral and such in the financial markets. That has created a whole lot of problems with the repo market over the last couple of years, and I don't think that we've seen the last of the problems in the repo market. And so I don't think it's even entirely possible for the Fed to just continually, increase QE if they, let's say, even though they're now talking about tapering. But if the market starts to slow in growth, if they feel like they need to give more of a boost to stonks and to real estate, if they just buy up more bonds, that might actually create create bigger problems in the repo market, which have a very immediate effect, and would, again, create new problems. So they might just even want to skip straight from increasing the level of QE that they're doing right now in the bond market and just switch to buying stocks directly. Because of the three major asset classes that I discuss on this channel, stocks, bonds, and real estate, the Fed currently directly buys in 2 out of 3 of those asset classes. They directly buy stocks, they directly buy bonds, and they directly buy, real estate derivatives. They buy mortgage bonds. But the one that they don't buy is stocks. And so maybe that really could be their key to trying to keep this party going, to keep the current ridiculous growth rates in the stock market, on current pace. And then they would not have to resort to continually doing more QE in the bond market and in the mortgage market, which is creating so many problems. This housing bubble is ridiculously out of control. The bond market is creating problems in the repo market that I do not fully understand. And so the Fed can kind of deal with those problems by quit buying mortgage-backed securities altogether at some point, and not buying more treasuries, maybe buying even less treasuries, buy just enough so that the Fed feels that they're keeping a lid on interest rates in general. Buy them as needed from the Fed's perspective, and then go into the stock market and directly manipulate prices to your own whim. And again, maybe at that point it's too obvious, but the Fed, I don't think, cares that much about optics. They act like they do, but at the end of the day, the Fed does what they want to do. So I've thought that it's something that sounds crazy before, and it wasn't my intention when I started recording today that I was going to talk about the Fed buying stocks and ETFs. But I just don't see where else they can go at this point. The slowdown in growth hasn't started yet, but it has to come at some point. I'm just, looking at a chart. Stocks do not move straight up forever. Can't happen. There needs to be, at the very least, a bit of stagnation. There needs to be some chop. There needs to be, things need to move sideways for a while. I mean, the market in the past year hasn't even been diagonal. It's been purely vertical. And the Fed, I think, understands that they need that to continue on forever. So, I guess I wouldn't call this an official prediction, but something to keep in mind. Something not to rule out as the Fed moves forward and as they talk about tapering certain aspects of QE, particularly mortgage-backed securities, which I would greatly appreciate. Although, if you ask me, I just would want the Fed to raise rates across the board, period. Rip the Band-Aid off, but they're not going to do that. The least, the best that we can get out of them right now is that they they taper mortgage-backed securities. And so here's to Jerome Powell, who will ensure that the stock market goes up 40% a year for the next 40 years, creating a whole new era, even more blissful than the great moderation that was ushered in by Alan Greenspan, our Lord and Savior. With that said, I will leave things off there for today.